Hi and welcome to the Martin Bell Show. Hopefully you've been keeping well, and in today's video we're going to be reading a news article from the Daily Mail Online. It's going to be about, I want to invest £100,000 safely to earn an income. How can my grandma put her savings to work to supplement her state pension with very low minimum risk? So this is kind of something I am looking to do myself. I'm a lot younger than her, but it will be interesting to see what they say to do and advice that they give her that may be helpful for me as well and may be helpful for you as well. As I said, this does not constitute as financial advice. This is just me documenting my journey and for motivational or educational purposes only. Capital is always at risk. So let's get reading. So we're going to read through this article, then I'm going to give you my thoughts and see if I've learned anything different. So it says here, my wife's grandmother has a spare £100,000 that she wants to earn some income from to supplement her state pension, which is a very noble goal, and it's very good to have £100,000 saved up. I'd love to be there myself one day, hopefully soon. She has no private pension and is fed up with a terrible savings rate, and that's true, because currently at the moment, the Bank of England is saying the national savings rate is 0.1%. She does have more cash savings that will be kept separate, but she wants to get this money working harder, earning at least to 3 to 5% a year. So, let's say the lowest amount, 3%, 100 grand. So that's an extra 3 grand a year. Divide that by 12, so that's an extra £250 a month, which is a lot of money, which will go a long way when you're in retirement, because you don't need as much money, because generally then you have everything paid off, hopefully by then, and then you should have a lower living expense. She does have more cash savings, I read that, however she does not have any investing experience, and while she knows some exposure to the stock market will be necessary, capital preservation is paramount. And that is true, because she needs to protect her savings because she's hitting retirement. The option to earn that money back is going to be very hard to do if that is the case, or practically much impossible if she doesn't want to go back or is unable to go back to work. So a nice little earner, how to invest £100,000 in order to earn a regular income. So this money says, one orthodox avenue is for your grandmother-in-law to consult with an independent financial advisor who can appraise her overall financial circumstances, recommend her how she can place her money to achieve her objectives, but this will obviously involve costs that will reduce the return made from the portfolio. We asked 3 experts from the investing world to give their suggestions, while we have a bonus idea that is presented at the end. Before I read any further, I'm going to give you my thoughts, and you're probably going to know what I'm going to say is index funds and ETFs is probably my recommendation, if I was going to give a recommendation, which is not. Assuming the reader's grandmother-in-law is in good health and at the age where she can expect to live for another 10 to 20 years, this provides a sufficient time frame to consider investing into help her meet her goals. Generally, the longer the investment time horizon, the greater the capacity to take risk. However, understanding her risk tolerance will be the fundamental, as it's not just about capacity for the risk, but willingness to take it too. That said, it's important to emphasize that all investments carry some degree of risk, and that's why they do. And that's why they yield more, because they carry risk. And the higher the risk, the more the yield, but the more the risk of default or not getting the yield that they promised. So given she wants exposure to the stock market while ensuring capital preservation, she may want to consider a balanced portfolio with moderate risk levels comprised of half equity and half bonds. A balanced portfolio should strike the right tone. If she is willing to accept periods of negative performance in order to strive for higher total returns from a combination of income and capital growth. Well, that's what I'm paramountly doing, is mainly for income and with some capital growth. This should help generate her desired income whilst protecting against the effects of inflation over time. If she wants to achieve some average return of approximately 3.3% per annum over the next 20 years, she could draw an income of £200 per month, inflated by 2% each year, while still maintaining £100,000 capital. That extra £200 a month would be, roughly say, first day month, an extra £6.60 a day. So it does add up. That could get you a few items, but that does all help out. That does pay the bills. That would pay the food bill, which is one of my main aims to get the food bill covered. Because I do like eating my food. I am in fairly good shape. Not massive, not great shape, but I'm in good shape. But I do like eating quality food. So it's important that in order to generate an average annual return of 3.3%, she should be prepared to accept that any given year in her investment pot could fall in value, while the longer run she can expect overall positive returns. She could also consider the impact of taxes of her net returns, utilising both capital gains allowance and personal allowance for income. It would make sense for her to think about moving £20,000 a year into an ISA to minimise the impacts of a tax. A process can be automated by an advisor like Net Wealth. So she has £100,000. If the rate stays set to £20,000, it will take her 5 years to get that £100,000 in the ISA and protected from capital gains and dividend tax. So Jason Hollands, Managing Director at online investment services Best Invest, recommends, these are incredibly tough times for income seekers. Interest rates on cash savings are at an all-time low. UK gilt bonds issued by the UK government are yielding a paltry of 2.7%, less than inflation, with last month's climb to 0.6%. And many UK listed companies slashed their dividend payouts last year due to the uncertainty created by the pandemic. While the worst is likely over for dividend cuts, with some previous cutters already recommending payouts, it will take a few years for the UK dividends overall to return to the levels seen last in 2019, which is fine. Which is okay. Most people who invest are going to have to accept there is some time periods where it may not be as stable as before, but that is the thing you take on when you invest. So it's saying here the most important message is therefore that it is an extremely low yield environment. There is no easy answer to achieving an income of 3 to 5% without taking on a degree of risk. However, I know that your reader states that capital preservation is paramount for their grandmother-in-law's savings. Even very cautious investment funds carry risk of capital losses alongside potential gains over a particular period in time. For example, in the event of a sharp fall in the markets, for those who can take a medium to long-term view of at least 5 years, there are risks that can be worth taking, as there will be more time to recover from the short-term dips, such as those seen this last March. And there will be dips and little peaks and dips and ups and downs, because the news happening, and bad news, good news, excellent news, terrible news, or people may even need the money, they may sell out their positions more, or something else comes up in the sector better and people trying to move the money there. There are going to be little dips, but as long as it's fundamentally sound, I don't think I will be selling my stocks once I get to own some single stocks. I don't currently own any single stocks at this moment in time, but I will be soon. I am looking forward to looking to purchase one. This is not a recommendation, but I am looking to purchase maybe Johnson & Johnson, or maybe Pepsi, or what's the other one, or a REIT such as Store Capital, or maybe even Realty Income. But I am looking to get some single stocks because I like the idea of having a few single stocks, but A majority of it will be in ETFs. For those who can take the medium-term, long-term view, or at least 5 years, these are risks that can be worth taking, as there will be time to recover from short-term dips such as those seen last March. However, if your readers' relative might need access to their cash at short notice and cannot tolerate the potential for a dip in value without causing them to worry, then it may be better to draw on the cash to supplement her pension income instead, particularly if they are very elderly. If some risk can be tolerated and her cash can be committed in expectation that the capital won't be needed for a reasonable period of time, 5 years in an income-generating investment fund with a high emphasis on trying to preserve capital that might be considered is a 91 diversified income fund. I might actually look into that one and see what they say. That seems to have been doing quite well over long periods of time. 5 years is up 25%, so that's 4 or 5 years. That's like over 5% a year, I think. Math. These investments in a mixture of asset classes, including shares, corporate bonds, government bonds, infrastructure, and property, and also techniques known as hedging to try to limit risk. Currently, the fund has 17% exposure to equities. That's quite low. In stocks, shares, the most volatile asset class, obviously it is, but then it has a greater risk for returns, as after the effects of hedging. The overall approach seeks to provide a far less erratic approach than a typical investment fund, while aiming for a target return of 4% per year through both income and growth, with a focus on the former. The current yield on the fund, the level of income paid out, is 3.88%, but it is important to realize that that isn't fixed. The fund can be held in the stocks and shares ISA, so distributions are not subject to dividend tax. Yes, so if you're not from the United Kingdom, or if you are from the United Kingdom, and if you don't know, a stocks and shares ISA is basically a tax-protected wrapper, so that all your capital gains and all your dividend payments are exempt of tax, and your dividends payments do not contribute to your £20,000 a year allowance. So you can reinvest in it and it won't eat up into your allowance. To get a decent income from her savings, she will not have to accept some level of risk and invest in the shares and bonds. The higher the income required, the higher the risk she would need to take. However, this can be reduced by diversifying investments and increasing exposure to less risky assets. A higher exposure to bond funds, which are typically less volatile than equities, would help. For an investment of £100,000, I would typically suggest a portfolio of 10 to 20 funds. Here I suggest some representative funds to illustrate. Having 70% in bonds is suitable for a cautious investor, and I would suggest the Jansen Henderson Strategic Bond, which yields around 3%. The managers, John Patio and Jen Barnard, sorry for butchering your names, are an experienced team who can invest anywhere in the bond market but have a focus on valuations. So I may actually look into this myself. I do have more time for it to recoup, but I would want some block on my investments to be quite cautious as well. So this could be complemented by Royal London Corporate Bond Fund, which invests in lower risk end of the bond market, but then team will also look for opportunities in unrated bonds to boost the income generated. They manage the risk by conducting detailed research. This yield returns about 3.36%, which is pretty good, and it's beats inflation, which is the most important thing. Equities also form an important part of an income portfolio. They also offer the ability to grow income over time, which is important given the inflation and prices are generally rising. Many dividends were cut in 2020, but we believe that is more of a reset and dividends will recover over the coming years, and they will. It will eventually recover. The Trojan Income Fund, managed by Francis Brugge, has a capital preservation philosophy and looks to invest in companies that can produce a steady long-term income and some capital growth. The yield is 3.5%, and I will look at all these bonds and these funds myself, and I may actually invest in some of them if I like the look of them. The UK is not the only place to generate an income, and it's important to diversify and equity exposure to other markets which offer access to different economies and cultures. The Fidelity Global Dividend Yield is 3.18% and is managed by Dan Roberts. The focus on companies with stable finances and strong cash flow, and cash flow is everything, will help underpin the reliability of the dividends. The fund has 31% invested in North America and 15% in Asia. While the yield on equity incomes are low, these could recover and grow as economics come out of the pandemic and things return to normal. This money adds. A cheap and easy option would be to look at some of the ready-made portfolios offered by a passive fund provider, Vanguard. These popular life strategy funds offer a variety of combination of exposure to government and corporate bonds and equities. The most conservative option is the 20% equity fund and devotes 80% to bonds. It returns 7.5% in 2020, and 9.9% in 2019, lost 1.1% of valuation in 2018 and returned 10.4 and 4.4 in 16 and 17 respectively. So that's pretty good. That is a pretty good return. While this past performance does not rule out the fund suffering losses in the coming years, it suggests it holds up well in a variety of circumstances. The fund fee is 0.2%, plus there are account charges, such as I'm with Hargreaves Lansdown. There's a 0.45% fund portfolio fee, but after a certain size, after it's capped at £200 a year. So as your fund gets larger than that, you won't be charged any more than £200 a year for a SIP for an account holding fee. She can set up regular withdrawal to provide an income for which there is no charge. Vanguard do not have many specifically income-orientated options, preferring a focus on total returns. I'm more interested in the income part personally myself. This means that investors can only have a more diversified portfolio, hence manage risk better, they say. Capital can be sold in order to top up income to bring it to a 3% or 5% as required. With a capital gains tax allowance at £12,300, a capital gains tax rates being lower than income tax rates also means investors' money goes further, they add. Your relative will have to think about tax. Only £20,000 a year can go into an ISA, and the other 80 would have to go into a general account and an income, or they could slowly transfer 20 grand over 5 years. That is another option as well. Or she could put the 20 grand in this year and then the other 80 grand in the general one, and then slowly take out another 20 next year. It's an option, but I'm not saying she should do that or she shouldn't do that. That is up to her. And some of the comment sections aren't the best. Yeah, the comment section are quite toxic today. So yeah, I'm going to look into some of them funds, and I found that quite interesting. Personally, I would be more wanting to go into ETFs, more passive, but I would look into some options of funds as well. and as well as some single stocks to play around with. And she could also personally do 20 grand in one, the tax ISA, and then the other 80 in the general one, and then take out 20 next year tax year and put it into the ISA, and then slowly build it up that way. So hopefully you found this video useful. I actually really found it quite informative, and it's given me some further options that I haven't thought of before, or funds that I didn't know about before. So hopefully you found this video useful. If you have, then please feel free to subscribe. Click in the bell notification button so you get notified when I next release a video, as well as if we also click on the like button, it recommends you like the YouTube channel. Well, other people will recommend it out. Also, I don't just do financial news, I also play video games, and sometimes we talk about investing, sometimes we just play video games, and I mostly live stream that normally, as well as I give you updates on how my investing is going and my portfolios, to show you a real portfolio from practically from scratch. Well, some of them are from scratch, how it's going from scratch to practically end, and to document that process to show you that it is possible. So thank you for watching. I hope you have a good day and you're keeping safe, and I look forward to seeing you all again soon.